Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Ira Epstein, and here we are, the end of trading on Monday, the 8th of August, 2011, getting on about 3:45 in the afternoon. And for you gold bulls, doesn't get better than this. You're up $70 today. Actually, probably closer to 63 when they finally finish the market, because it'll go back to the 12:30 Chicago time. However, that's a heck of a run. Silver acted poor as can be. Copper market's in the toilet, so what's going on? I'm not going to waste the time explaining to you the surprise move that Standard & Poor's did at the close of business Friday. It just freaked the market out that America actually lost its AAA status. In fairness to Standard & Poor's, they warned America. They gave them what the warning was. We didn't pay attention to it, or we did and we didn't care. I don't know which one of the two. I know that there's changes about to happen because of all this, and those changes will be very interesting politically speaking. Just think about it. You're not that far away from election time, and I think that we are fed up. At least this person is. All right. So having said that, we saw the stock market take it on the chin, almost 700 points in the Dow, about 80 handles, and we're getting a little bit of a bounce after that, so we're up 2.5 in early evening trade. So what? The market's in trouble. The big rally happened in the bonds and notes, and people kept saying, and the theory is that if you lose your credit rating, your interest rate structure goes up. Yes, that is right down the road. But for the short term, it so spooked the market that safe money went to two areas today. They went to Treasury instruments in the U.S., so the opposites happen. Interest rates are collapsing, and it went to the gold market. That's pretty much all that it really went to. It certainly didn't go to the energy market. That collapsed today about $7 a barrel. Now, in looking at the gold, look at how this market took off. But I think there was a head fake on Friday. This pullback in the gold on Friday was, to me at least, bothersome. This move, nobody called me and said Standard & Poor's was doing anything until all the markets were closed, and there's not much you can do after that. So you opened sharply higher, and you just kept going all night long. I'll blow up the chart so you can see this and show you the swing line study. The beauty of the swing line has been that it's still defining uptrends. Higher highs, higher break lows. Got it? So that part of the market doing just what it should do. Where's the market in relation to the 18-day average of closes? I know that this theory, it sounds so simplistic, and so few traders really pay attention, in my opinion, to it. But I will stick with this line in the sand. When the market is over the red line, I am telling customers, those that take my trading course, you're looking for potential buy signals. It's one thing to get out of a long, but you're not taking short signals over that number. And I think it's done you pretty good in recent times. And I know what it's done long term because it's been one of the things that I base trading recommendations on. What else? The 18-day, the red line is over the medium-term average, the 45. The 45 is over the 100. Everything's bullish in that term. So the market's got the moving averages pointing up, the swing line pointing up as well. I thought, and I want to go to Friday, this was the action on Friday. The market had been over the Bollinger Band. One day it couldn't hold it, and when it started pulling back, I thought there was a good chance the market was going to run for wherever the 18-day average of closes was. Obviously, that's not what occurred with the explosion in price today. Also, and I'm going to take you back to Friday, you lost your embedded stochastic. Most times that means you go back to the 18-day average, and that would be a little higher today just with the math of how it works, and I thought that was going to happen today. So I was one of these people, bullish the gold market, that told my customers on Friday to come out. You maybe should never watch me again. I don't know what more to say. And today you got the pop. in all fairness, no way to know S&P was going to do what they did. Didn't know what the reaction to it would be, even if they said they would do it. That's the first thing. Second, Europe coming in and all of a sudden having an emergency phone conference to start massive buying of Italian bonds, possibly Spanish bonds, setting back into play what? All the sovereign debt issues that you can imagine. Okay, but I also have not told anybody to be short this market. I'm writing reports that I think the market will be up from July 31st by the end of December, conservatively 5%, from 16 and a quarter to 17.20. There's still some room there, obviously, to go, and probably I said a minimum 5. I'm wrong. I think it could be now 20%, maybe 15. Wouldn't surprise me. You've just got everything set in motion. Will there be breaks along the way? Of course, there always are. Nothing goes in a straight line very long. You've seen that. But if you got to jump in, what can I tell you? Dollar risk to me is still everything. Missing a move is one thing. Getting caught on a day like today wrong, that's a very different thing for the way that I look at the chart. Silver to me. Let's take a look at Friday. This is Friday where the market closed. Do you see anything at all bullish on the silver chart? I don't see how you can, but you can argue, hey, Ira, you hit your Bollinger Band. That should be the area that you take money off the short side of the table. What else would you be looking? Resistance at 39.75, but the stop would have to be 42.30, one tick over that high. Too much risk, but bear market condition, resistance 39.75. Today you went up to 40.40, came back. I don't think you hit the 38.15 yet, which is the Bollinger Band, but it wouldn't surprise me. So I'm definitely not in the bull camp here. I still see bearishness in this market. Here's a market that's just falling apart. It went from 454 down to 392 and a quarter roughly in all of, get ready for this one, 1, 2, 3, about 5 days. What else? I'm going to show you something on the chart that you have to review. This is an outside day down where the market finishes lower and you've taken out 441. Therefore, on this day, what are you, bullish or bearish at this point? You should be saying you're in the bear camp. You've closed under the 18-day average. You got under 441. The real person out there will say, well, if I go short in this area, I got to risk up to 454. It's too much money for me to risk. I can accept that. But you can't say that you're bullish. The market hangs around there on Tuesday, goes down and hugs the Bollinger Band. That's normal. You're oversold as well. So maybe you're going to get a rally or two. You're looking to get out of the oversold condition, but there's nothing that you're bullish on this chart. That's my point here. Here's the market coming down. This was Thursday. How many days do you normally stay under a Bollinger Band? Not more than 5, but you're coming down. You're still not more than the 5. And today, of course, is the washout day. So now what I tell customers is I'd be looking for two things to happen. The Bollinger Band to drop more, price action to soon stabilize, and you are oversold. Before I go on, I want to remind you about my free futures trading kit. If you haven't had one of my webinars, you want to take a look. It's posted. It's out there. So busy today, I don't even know if we sent notice to people, but it's been up all day long. You can't see it if you're watching the YouTube. It's a subscription-only service that I make free if you've not seen it before. Before you pay for any subscription, I think you want to look at this, get a good idea of what it is. You call us at 1-866-973-2077. We'll make certain that you get access. Here's crude oil. Crude oil is not a storage of value. But do you remember, and if you don't, I want you to go back at these videos, and I kept saying, you know, something's brewing here. Market is narrowing in. This is not normal. The longer that goes, if it breaks out, be careful. This is last Tuesday. Seems so long ago, doesn't it? Last Tuesday. Market's in a definitive downtrend. You're making lower lows. You're stopping at the 18-day average of closes. You are in oversold territory. You got a 20 reading. Market works its way down on Thursday. Now you've got a market that I think's oversold. The odds of staying under the Bollinger Band, not great. I want you to watch this, and here you're going to come into today. So now you're 5 days in a row under. The odds of being a sixth are very small, but it can happen. Can. But this is not, my point is, this is not the area to go short. What else do I want to explain to you that's going on? This is a very interesting chart that you watch. What's really going on is that a number of commodities are adjusting now what price levels they're going to trade around. So we have seen on this chart that the 105 area is too high. And now that we're coming down, is it going to be the $75, $80 area? The market will tell us. But on the rallies back up, it's going to take a heck of a move to make this market go. What else did you just learn out of crude? It isn't a storage of value. It's a commodity. The only storage of value out there at this point in time is gold. That's simple. That's the market that's getting it, and there's one other market, and I know that you don't want to hear that. U.S. Treasuries. They're the markets that the big money's still flocking to because the U.S. does pay its debt. And I'm not sitting here as a patriot. I'm just telling you that those are the two areas that the market is still looking at. This is a consumable product, and if you hurt consumer confidence, it does pay attention to the law of supply and demand. I'm Ira Epstein, the law of supply and demand. I'll be here tomorrow. Have a good day.